Hi everybody, Ahmed here. You can see a picture on the screen right now. It is being circulated over the internet and it is of a notepad left by the US Treasury Scott Bessent in the cabinet meeting over the table. And it clearly says that by Japanese yen, 5 to $10 billion. One thing which is very unique here is that the joint intervention between the Japanese government and US Treasury is the first of a kind in 15 years. And between the Japanese government, not the other governments, it is first of a kind after 28 years. So the question arises here is that the more open question, because obviously the Japanese government intervenes a lot. It intervenes recently, but why the joint intervention? Okay, why the US has to be so open right now to do the stuff that the Japanese government is trying to do? So the intervention by the United States is not a big part of the whole intervention. Like the estimated numbers are that the total amount was $60 billion, and the United States actually played a part of only the maximum of $10 billion. Secondly, the question is about the career of the United States Treasury Scott Bessent. He's one of a kind. Like, he was a hedge fund trader and he has decades of experience in that game. So we are pretty sure that his mental models are clearly built for that kind of environment. And now, being a US Treasury, how this is clearly intervening in his job. I'm just going to shed some light on it, but not much. And let's first talk about the first question. The answer is pretty simple. Japan is the biggest holder of US Treasuries. Obviously, the first step that Japan was going to take, selling the US Treasuries and buy the Japanese yen in the open market. Obviously, that Japan may have some liquid cash of United States dollars in its foreign reserves, but currently the situation is very pretty much effed up, and you can see that it needs some reserves in its accounts for the imports, because the Japan's energy is 97% imported. So the current Middle East war is actually putting that kind of pressure on its FX account. But Japan has been doing this before. One thing is that if United States directly wants to intervene, there must be some kind of a dark truth. Not dark truth, but some kind of mega motivation. And US Treasury Secretary actually projecting this like, he's saying the words, we are protecting the global economic security, countering the disorderly yen movements, and Treasury will not hesitate to participate in further intervention. Yeah, the traders are actually betting against the yen because of these words, and calling the yen substantially undervalued. I must say that this is kind of a parabolic stance, and he's just playing the words game, just like the President Donald Trump actually do. He said that he encouraged Japan to use the Federal Reserve Repo Facility, which is FEMA, and Japan has actually accepted that we are going to see that kind of facility to be used in future. But all of this is just to prevent an ally from dumping the American securities. So the mega motivation behind it is that United States long-term treasury yields are on the rooftop. You can see that, not just because of the Federal Reserve, the hikes kind of environment that traders are saying that the rates must be hiked up in the United States, and the market is doing that kind of job to making the long-term yields go higher and higher. It is so high that if the Japan is going to dump the securities to US securities, then that is going to put pressure on the long-term yields. The traders, the speculators are going to put that pressure and make the pressure further because of their own expectations game and the trading behavior. And that is kind of a concern for the United States. And you can see that the 10-year treasury notes are already 19 months high right now. And why I'm pointing to this specific treasury notes is because these are used as a benchmark for a lot of corporate loans, mortgages, and or auto loans. And it is this benchmark is pretty much used for the commercial debt a lot. And also, the Trump has midterm elections ahead. The problem with the Mid East war, and these two things are actually putting the pressure on him for his midterm elections. And now the administration is looking for the solutions in the sideways for this kind of situation. And this is why the US Treasury Secretary is so open talking about the yen intervention and intervened along with Japan after 28 years. So this all helped by the United States actually had the yen to get some stable numbers. And before the intervention, it was trading at almost its weakest level since the 4 decades. And it was already the worst performing currency in the group of 10 over the past 12 months. Because of its relatively low bond yields and also some concerns around its fiscal and monetary policy credibility. And also, the US Iran war is actually putting a lot of pressure on its imports. So, considering all of those factors, the yen was so weak. And the intervention actually helped a lot to get the yen into a stable kind of territory. So, one thing is important to ask is that is this even working? Like, is this going to do a job for the yen? No. I must say that the interventions by the government, most of the time, actually, they are just there for short term. They actually don't have any effects for a longer time frame. We can see the last intervention by the United States and Japanese yen in 1998, and you can clearly see it on the graph that the yen reversed back. But what's the clear fix? The clear fix, the long-term fix, is actually Japan raising the interest rates, which are still negative in inflation adjusted terms. Actually, Japan is raising the interest rates and it's on the track. It's called normalization. And you already know the interest rate environment in the Japan for the past 30 years that it was kind of a negative and on the zero side. And now, because the spread between the United States dollar and the Japanese yen, the interest rate differential is so big that it is keeping the yen on the lower side. And now you can see that the rate hikes concerns actually erupted during this year for the United States. Before the war, there was a dovish sentiment across the economists and traders. Earlier this year, there was some hope that the interest rates are going to get lower and the differential between the both countries are going to get tighter. That would have helped the Japanese yen to get some strength. But now the rate hikes are concerns are back in the United States also. Japan has to do more work on its own monetary policy side to do the job for the yen for a longer time frame. So why the normalization is actually not happening at a speedier pace? There are some political concerns in the economy and the government right now that the prime minister of the Japan actually have some incentives. Obviously, every other kind of the government official, the president or prime minister, whether the president or prime minister has the incentive to keep the interest rate lowers in the economy to boost the economy and get the numbers from the voters. But the Japanese prime minister actually have some more legitimate powers to do this, and she's actually playing out that game and keeping the interest rates lower and slowing the normalization of the monetary policy in the Japan. And yes, this fix is actually very credible. You can see right after a few months after the intervention between the by the United States and Japan in 1998, the US started to cut interest rates and the differential got tighter. And you can see here that the Japanese yen strengthened a lot and stayed inside that stable territory. So now let's go back to the US trade Scott Bessent's trader instincts and doing the job of the US Treasury Secretary is hard. It has to see a lot of different sides, and trading is also hard at the different level. It has also to see the a lot of different sides, but the playbook in the treasury and government official is environment is somewhat different, and it is kind of constrained between the laws, and you cannot play the games with your delusions. And yeah, the Treasury Secretary is actually giving an option of using the FEMA repo facility, as he's saying that it is an important backstop. But the clear thing about the FEMA facility is that it is more expensive than borrowing dollars in the private repurchase agreements. FEMA facility is kind of United States is going to lend the dollars by making the Japanese government to pledge its own US treasuries rather than selling it outright in the market to get the dollars. So to do this job, there's kind of a interest rate payment. So the FEMA facility is pretty much expensive as compared to the normal interbank lending. And policymakers actually made this for a kind of a backstop during the periods of market stress, and it actually got invented during the pandemic time, and when a lot of non-US central banks were selling the treasuries to raise the dollars. You may be thinking that why I'm talking about this. I'm talking about this is because the FEMA facility is actually very well established under the Federal Reserve legislature. Okay, the Federal Reserve has more powers over the FEMA facility, extending it, making it more broader rather than the US Treasury. US Treasury giving the option of using that and kind of saying that it is going to influence the Federal Reserve to make this more available for the Japan in future. It is not a kind of a normal persona of the US Treasury Secretary. Like this kind of influence and this kind of broadening authority of the United States Treasury Secretary is kind of abnormal. Such kind of behavior is giving the trader instincts, and it has some kind of political element inside. So this was what I wanted to talk about his hedge fund side, and yeah, I think I have discussed all the important elements around this yen intervention episode. And yeah, this was all for today's video. And if you want to talk about something else and have some thoughts, you can just put it down in the comment section. And let's meet in the next one.